What's up, ladies and gentlemen? Welcome back to the channel. It's your boy, Jesus Kushina FX, and you're back to King's Crown Academy December locked in mentorship. All right, so this is episode 2 of my lecture, and today we're going to be looking at institutional order flow. We're going to be talking about institutional order flow. What is institutional order flow? All right. So for those of you joining the class for the first time, this is an advanced locked-in mentorship program, and it's a free mentorship program, and you're welcome to join. All right. So grab your notepad, grab your pen, grab your snacks, and let's lock in. Okay. Institutional order flow. All right. Yeah, you cannot talk about institutional order flow without first discussing about market structure. All right. So market structure in institutional order flow is just basically talking about the language of the market. All right. And then it's talking about how the big players um, show us their moves. All right, how you read what happens, all right, by the influencers of the stock market. All right, so market structure is the language the institutions speak. Okay, there are only four major structures. We have a bullish order flow. That's where you count your higher highs and higher lows. And then you have your bearish order flow. That's where you count your lower highs and lower lows. All right. And also you have your change of character, all right, and you have your break of structure. So all these are the major ways we kind of interpret the institutional order flow. Okay, so when you see displacement plus break of structure, it leads to the fact that institutions are active. All right, that's a very simple way of knowing that the institutions are interested in that particular zones. Okay, and when price return to the origin of a particular displacement, institutions are saying we are coming back to mitigate these positions. All right, so that is how you'll be able to interpret these moves by the institution. All right, so one important rule about this is that you should never trade against the structure formed by the displacement candle. Okay, I'll be showing you later on this chart with various examples, practical sections. All right, why you should never trade against the overall market structure of the institution. Okay, so the institutional order flow structure, they control the market, all right, and not the retail structure. Okay, so most traders that only rely on lower time frame for interpretations of the market, you need to shift your bias more to be able to look out for what the institutions are saying, all right, using this language. All right, so yeah, this is an example of a bullish swing structure and a bearish swing structure. All right, here you count your low, your high, your higher low, higher high, your higher low, higher high, and every higher high means there is a break of structure. All right, so that's exactly what this particular chart is just showing. It's just an example of what a market structure is. See that you have a bullish structure or you have a bearish structure. All right, the berry structure, you count your high, your low, your lower high, your lower low. All right, lower high, lower low. Every lower low causes a break of structure. So, like that, that is how you interpret the chart. Now, what is institutional order flow? Well, institutional order flow simply means the direction or and the intention of smart money, right, entering the market. Okay, so it's practically telling you that retail traders trade pattern, but institutions trade liquidity. Okay, so they move price using large blocks of orders. Okay, so institutional order flow answers three basic questions: who is buying or selling? Where are they likely to enter from? All right, and who do they engineer liquidity before moving the price? Right, how did they engineer the liquidity while we're trying to unravel this lecture? Okay, so you're not trying to predict the market, right? You're trying to understand the behavior of the entities that actually move this market. All right, for example, the IT banks, the hedge funds, the market makers. Okay, so you just want to know how they move the market. So this is a chart example of a buy side order flow. Okay, so you can see on this chart how price rallied, creating higher highs and higher lows. All right, so it's just a projection of what an order flow means. Okay, so this is a particular chart that shows you that. All right, so moving forward, How institutions move price? Well, institution, one thing you need to know is that they don't chase price. No, they never chase price. Rather, they create the liquidity and then they use that liquidity. It's just like rinse and repeat. It's a circle. All right, it's a circle. First, you see a liquidity grab. All right, when you come to your chart, sometimes price will just run above old highs or below old lows. All right, um, why is because stop losses are liquidity, okay? And most times the institutions knows that retail traders are hiding their stop losses around some key zones, so they practically just go for it. All right. Sometimes they create an inducement and trap early buyers or early sellers and then use that particular order flow as a liquidity. Okay. So another thing is mitigation and rebalancing. Well, you need to watch out when price returns to an institutional footprint. For instance, if you go to your chart, areas of imbalance, areas of fair value gap, areas of order blocks, areas of previous inefficient moves. These are likely areas of mitigation that price usually rebalance. All right, institutions move price intentionally to rebalance price in such areas. All right, so they come back to fill those particular zones. Okay, so how institutions move price continues. All right, so this is a continuation, right? So the third is displacement. All right, now under this displacement, this is where the real move starts. Okay, this is where they give you a strong directional push after grabbing liquidity. All right, so this is where the real move start. Okay, now most times after that, what we see is a continuation or a reversal depending on the higher time frame order flow. All right, so price moves in that circle. Price move in that circle, liquidity grab, all right, a mitigation, displacement, and a continuation or a reversal. All right, so this is how price move. So institutions move price by engineering zones where retail traders, all right, get trapped. Now we simply learn to recognize their footprints. So it's your duty as a retail trader to often recognize where these footprints are being laid. Okay, so quickly let's go to an example. Today's lecture, I'm just gonna be very fast because I don't want the video to probably be lengthy. So I just want to hit the nail on the head. All right. So on this particular chart example, you can see how the institutions move this market. All right, so the at some point the order flow changed, all right, from a bullish to a bearish order flow and back to a bullish order flow. All right, but overall, all right, we're trying to like view this chart like smart money. All right, not retail traders. Okay, so we focus on higher time frame narrative, for instance from 4 hour, from daily, and that is how we will be able to come up with this example. So during this 4 hour chart, you can see that price rallied up to the upside, created a bullish order flow, which causes a break of structure, leaving a displacement candle, all right, where that displacement candle also had a fair value gap, okay, and above it are liquidity. All right, so after price rallied up, all right, it's retraced back into that imbalance. All right, you can see the fair value gap there. All right, and it became an inducement, all right, for sellers. Okay, so but then price only came back to fill that imbalance, okay, and sweep the liquidity resting just above the fair value gap, and then price continued upward. All right, which also trapped early buyers. All right, it trapped early buyers and it trapped early sellers. Now price came back, swept the inducement, all right, now swept the overall liquidity, and then price started rallying to the upside. You can see on this chart example. All right, so that is how the institution move the market. First they grab liquidity, they create the liquidity, they absorb the liquidity, they come back, they mitigate a particular zone, be it an imbalance, a fair value gap, or a particular order block. All right, so or a previous place that inefficient move happened, they come back, refill that particular place, and the displacement begin. Okay, so your duty as a trader is to make sure you get involved after the manipulation. All right, now let's talk about the power of fair value gaps and imbalance. Okay, this is one of the cleanest institutional order flow concept. All right, when you talk about fair value gap, all right, so fair value gap is often characterized by a three candle pattern, right, where price move too fast, leaving an empty space either below. Okay, now if one candle is high below the candle three, it means that that particular imbalance remains unmitigated. Okay, so institution always revisit this zone and rebalance those price. Now you might be asking why fair value gap matters. Well, it shows you exact footprint of the institutions where they left and unfilled orders. All right, so it shows you that okay, this is a particular place where they moved the price, they injected a particular amount of money to the chart, and then it particularly moved. All right, now it shows you the true origin of a trend, and it also show you where price might likely return before a continuation. Okay, so I want you to go to your chart. You can spot some fair value gaps and imbalance, mark all of them from 1 hour chart or 4 hour chart. Just try and back test this and be able to recognize it. Okay, now but then there are rules for trading fair value gap. First of all, well, you need to trade fair value gap in direction of the order flow. Okay, and also you need to combine the break of structure and change of character. Okay, best fair value gap happens after a liquidity sweep. You can write that down. Okay, I'll show you on the chart. You use lower time frame for refinement to minimize your stops. If you understand fair value gap, 50% of institutional order flow becomes easy. All right, so this is a chart representation of a fair value gap, the power of fair value gap. Look at this chart closely. Okay, price rallied up to the upside. All right, price rallied up to the upside, causing a particular displacement. Okay, the displacement left fair value gap behind, and also just above the displacement there's a heap of liquidity resting there. Okay, now the displacement caused a break of structure. After the break of structure, price came back to fill that imbalance. All right, and also sweep the liquidity resting below there. Okay, before moving on. This is exactly how to use fair value gap. Okay, now this is another chart. Okay, bless me. This is another chart. Okay, so immediately after that, you can see that price also went up and grabbed another liquidity before moving downward. All right, and that is how we call this particular trade. Okay, so we waited for price. We actually caught this buy, but then we also caught this sell on that very day. Okay, so I just used this to show you the institutional order flow movement, how they manipulate the chart. Okay, so this is the example, and also you can see the buy side liquidity resting above there. They are still going to go for that particular liquidity. Okay, so it's all about you understanding why a particular thing happened on the chart. Okay, and that's why we are here to break things down for you. Now, other blocks and mitigation. Well, another block is the last opposite candle before a displacement. That's what another block is. Okay, the last bullish candle before the sell-off, or the last bearish candle before the rally. Now, you might ask why other block matters. Well, institution fill orders in phases. They don't just fill it once. So if price want to run a particular distance, it does it in batches. It does not just run it, instantly. So when price return to another block, well, they are mitigating, closing earlier position or adding to a new position. These are the things that happens when price comes to a particular order block. Order block is a very powerful trading. In fact, the smart money concept, all right, is purely based on order block. Most times, SMC traders, if price does not come to a particular order block, they count it as a missing trade for themselves. All right. So yeah, other block entry rules. Number one, price must produce a real displacement and not a small noise. You must be sure that this is a big displacement candle that leaves a fair value gap behind. Okay, so you used the most efficient order block, the one that created the break of structure or the liquidity grab. I will show you and a live chart, my live chart example of what I mean by this. Okay, step 3, refine the order block on lower time frame. Okay, step 4, always pair order block and fair value gap as a confluence. It gives you a high probability. Now when price taps order block after sweeping liquidity, that's where you get your snapper entries. Okay, now this is a chart representation of what I mean. Back to this same chart example. Okay, you can see that here price produced a good displacement. All right, the first displacement, which caused a break of structure. Okay, and the displacement was very obvious. It was very, very obvious. You can see it's very, very, very obvious. And then it left a fair value gap with a liquidity resting there. Okay, now you have to make sure that price comes back and fill that particular imbalance. Okay, price comes back and fill that particular imbalance before reacting. Okay, now if I marked correctly, you can see when we cut this sell trade, we cut it based on order block just up here. You can see the breaker block up here. Okay, you can see the breaker block. All right, so what happens is this: when you are using order block as a forex trader or as an SMC trader, you must wait for price to tap in properly, maybe grabbing a liquidity before you actually take that trade, because that's the only way you can get sniper entry off the chart. Okay, now how to trade with order flow. Here is a simple professional SMC, all right, stroke order flow model you can use. So I broke it down into 5 steps. Okay, I broke it down into 5 steps. First of all, determine higher time frame order flow. What is the overall market trend? What is the overall market structure? All right, are the big buyers looking bullish? Are they looking bearish? After that, identify liquidity pools. Where are the liquidity resting? Above my weekly highs, above my daily highs, above my fair value gaps, above my order blocks. Where are they hiding? When you identify the nearest liquidity pool, wait for the liquidity sweep. So make sure that price sweep either old highs or old lows. All right, you must make sure that you see that. Then after that, step two, you wait for a break of structure or change of character or a displacement. All right, what this means is it confirms that institutions are interested in buying from this particular zone. Okay, again, you enter on the mitigation of that zone and make sure that price comes back to that particular fair value gap or order block. All right, before you take your trade. Now this is how you trade like the institution. You are not guessing anything. Okay, so this is how you actually trade. Now this is it on this chart. Okay, now we waited for price to actually sweep the overall liquidity resting below, all right, before we engage on this particular trade. That is how we call this particular trade. All right, we waited for price to give us a break of structure, change of character, displacement, and we entered on the mitigation zone. This is exactly what we did on this chart. Okay, this is another chart example. Now based on this example, we waited for price to raid the buy side liquidity. All right, so waited for price to grab this liquidity on the buy side. All right, and had a purge, gave us a clear confirmation for a reversal, and then continuation. This is how we call the alternate sell. Okay, so just using this particular model, you're gonna be seeing that trading is not easy, but you can make it easy just following this simple step. If you want to learn how to trade like the institution, rewatch this video again. All right, rewatch it again and digest it. Okay, so I gave you practical life example on the chart. Look at this particular chart. Now you can see after my buy side liquidity was raided, I made sure that price pulled back properly. And after I saw the rejection, all right, I knew that the order flow has changed from bullish to a bearish order flow. And that was how we caught this sale. And look, immediately price got to a discount level, the order flow changes again. All right, so that's exactly the steps to apply when trading institutional order flow. Okay, so like I said, this lecture was just gonna be very brief. All right, so in conclusion, institutional order flow is not magic. All right, it's not manipulation. So it's just by understanding the market, all right, understanding how it actually works. So if you focus on structure, liquidity, displacement, and mitigation, you will stop being the liquidity. This just make sure that you understand structure, you understand the liquidity, where the liquidity is resting, you understand displacement, okay, when the institution has entered the market, then you understand mitigation of that particular displacement. You stop being the liquidity, all right. So you start following the liquidity. Okay, again, don't forget the December mentorship is still going, all right. But by the time we finish, I'm sure you guys gonna have clarity on what you've been missing in your trading journey. Okay, but make sure you join the next class. um I'll be breaking things down with much more life example. Okay, so I'm gonna build your trading system after this December mentorship. Okay, so see you in my next class. Don't forget, if you want to get any of the courses, all right, just go up on selar.com. I've prepared all these courses down for you guys, prepared you a lay down principle of what worked for me and what worked for my community and what we are applying. All right, so I remain your boy Jose FX. All right, keep